Let me ask you something. Do you ever look at the truly wealthy? I'm not talking about lottery winners or one-hit wonders, I'm talking about generational fortunes, yachts, private jets, running empires, and you think it's some kind of magic. It's not magic, it's a blueprint. It's a disciplined, cold, hard strategy for making money work for them, not the other way around. Most people are tourists in the world of finance. They dabble, they speculate, they listen to their idiot brother-in-law about some hot stock tip. The rich. They're not tourists. They're architects building financial fortresses designed to withstand anything and everything. You think your savings account is doing you any favors? Let me tell you, it's a leaky bucket. Inflation, the silent killer of wealth, is eating your cash alive every single second of every single day. While you're sleeping, your money is getting weaker. The ultra-wealthy understand this. They don't hoard cash like a dragon on a pile of useless gold. They deploy it. They put it to work in armies of assets, each with a specific mission: growth, income, protection. They treat their capital like soldiers, and every single one of them has a job to do. If a soldier isn't performing, it gets cut. It's that simple. It's brutal, it's effective, and it's the only way to play the game. Over my career, I've seen it all. I've seen brilliant ideas crash and burn because the founders didn't understand the first thing about capital. And I've seen mediocre businesses turn into cash printing machines because they were run by people who understood the fundamental principles of investment. It's not about having a revolutionary, world-changing idea every single time. It's about understanding the mechanics of money. What we're going to discuss in this series isn't some get-rich-quick nonsense. This is the playbook. These are the top 10 asset classes the rich use to build and, more importantly, preserve their fortunes for generations. So listen up. If you're serious about changing your financial destiny, you need to stop thinking like an employee and start thinking like an investor, an owner, a capitalist. It's time to pull back the curtain and look at the machinery of wealth. Don't be a financial cockroach, scurrying around in the dark, hoping for scraps. Be the chef. Understand the ingredients, master the recipes, build a feast that will last a lifetime. Let's start with the absolute bedrock, the cornerstone of almost every significant fortune on this planet. Real estate. There's a reason they say real estate. It's tangible. You can walk on it. You can touch it. You can see it. It's not some ethereal line of code or a piece of paper that says you own something. It is the something. The wealthy don't just buy houses. That's what amateurs do. They acquire strategic parcels of the earth. They understand that God isn't making any more of it. It is a fundamentally scarce asset, and therefore valuable, that provides a level of security that other investments simply cannot match. It's the king on the financial chessboard. First, cash flow. I love cash flow more than almost anything else. A well-chosen property becomes a revenue-generating machine. Residential apartment building, commercial office space, industrial warehouse every month. Like clockwork, tenants pay you for the privilege of using your asset. This isn't speculative hope, this is contractual income. It's a steady stream of cash that flows directly into your pocket, paying down your debt, funding your next acquisition. It's the financial heartbeat of a robust portfolio. Then there's the beautiful concept of appreciation. While your property prints cash, it's also silently growing in value. Population growth, inflation development in the surrounding area. You're getting paid to wait for your asset to become more valuable. Combine passive growth with active rent income. You have a wealth creation engine that's unparalleled in reliability. It's slow, it's steady. How empires are built, brick by boring brick. And let's not forget the leverage. This is the secret sauce. Walk into a bank and get a loan to buy a $1 million building with only a fraction of that in cash. The bank gives you the rest. Control a $1 million cash-flowing asset with $200K of your own money. The tenant's rent pays the bank's mortgage. It's the ultimate financial hack. You are using other people's money to buy an asset that other people are paying for. If that doesn't get your capitalist heart pumping, you might already be dead. This is the power of real estate. Now let's talk about something near and dear to my heart: not giving your money to the government. The tax code is a labyrinth of rules designed to take your hard-earned capital, but woven into that labyrinth are golden threads for real estate investors. Depreciation is my favorite word in the English language after royalty. The government allows you to deduct a portion of your property's value from your taxable income each year, assuming it's wearing out. But here's the beautiful, beautiful irony. While you're claiming this loss on paper, your property's often appreciating in the real world. You are legally reducing your tax bill while your asset is actually gaining value. It's magnificent. It's the quadruple threat of investing. It is the foundation upon which you can build the rest of your financial empire. If real estate is the foundation of your financial fortress, the stock market is the engine room. It's where the real explosive growth happens. We're talking about equities, owning a piece, however small, of the largest and most innovative companies in the world. When you buy a stock, you're not just buying a ticker symbol on a screen. You are becoming a part owner of a business. You are entitled to a share of its profits, a piece of its growth, a claim on its assets. This is the essence of capitalism, and it is the most powerful wealth creation machine ever invented by humankind. Now, the average person treats the stock market like a casino. They buy high and sell low. In a panic, they try to time the market. The wealthy don't gamble. They invest. They understand that over the long term, the market's trajectory is relentlessly upward. Why? Because humanity innovates. Companies create new products. They become more efficient. They expand into new markets. The key is patience. You don't rent stocks. You own businesses for the long haul, letting the power of compounding do the heavy lifting for you. It's the sound of a dividend hitting my bank account. It's the sound of a company sending me a check, thanking me for being an owner. This is the other half of the stock market equation: income. The real magic happens when you reinvest those dividends. You buy even more shares, a growing snowball of wealth. The wealthy focus on quality. They don't chase meme stocks. They look for businesses with a moat, strong balance sheets, consistent earnings, a long history of raising dividends year after year. These are the aristocrats of the market. Think like an owner. You buy quality businesses, you hold them, you reinvest the dividends, you let time do the work. Its power to generate staggering wealth over a lifetime is anything but. This is how you harness the engine of capitalism for your own benefit. Quick break. If you're serious about mastering these assets, tap subscribe, like this video, and share it with someone who needs this playbook. Then let's get back to building your fortress. Back to work. You can spread your capital across hundreds, even thousands of companies, diversifying your risk across different sectors and geographies. It's the growth engine you can't afford to ignore. Let me tell you something about real money, the kind of money that doesn't just grow, it multiplies in the shadows. This is the major leagues, the inner sanctum of wealth creation. We're talking about private equity. Buy into companies before they're household names, before they hit the stock exchange. The ultra-wealthy don't wait for opportunities to appear on a ticker tape. They go out and create them. They get access to deals the average person will never even hear about. The most common type is the leveraged buyout, or LBO. It sounds complicated, but the concept is beautifully simple. You identify a mature, stable company with predictable cash flows. Then, you use a significant amount of borrowed money. That's the leverage to acquire it. The company's own assets are often used as collateral for the loan. It's like buying an investment property with a mortgage, but instead of a duplex, you're buying a multi-million-dollar corporation. The goal is to use the company's own cash flow to pay down that debt over time. The private equity firm doesn't just sit back and collect dividends, they roll up their sleeves. They might bring in a new CEO, cut costs, drive efficiency, increase profitability, increase overall value. After a holding period, typically 5 to 7 years, it's time to exit. There are several ways to do this. We're talking about multiples on your invested capital. 2 times your money. 3 times. Even 10 times. Of course, not every deal is a home run. Some fail spectacularly. That's why this is a portfolio game. Specialized funds, family offices, syndicates, the gatekeepers with teams to do deep diligence. It's a club, and the membership fee is substantial capital and an ironclad network. These are illiquid long-term investments. Your money is locked up for years, but with that illiquidity comes a premium, a reward for your patience and your conviction. High stakes, high reward, capital, patience, and nerves of steel. All right, let's shift gears. You need defense, you need a foundation. You need something that protects your capital when the markets go sideways. Think of a bond as a loan. It's that simple. Lend to a government or a corporation. They pay you interest, coupon payments, and, at maturity, return your principal. It's a legal promise. For the ultra-wealthy, bonds serve capital preservation. The goal is to stay rich, They anchor net worth in stability and predictable income. But there are risks. Interest rate risk. When rates rise, existing bonds fall. Credit risk. The issuer could default. The wealthy focus on high-quality investment-grade issues from stable governments and blue-chip corporations. They build a bond ladder, staggering maturities to manage interest rate risk and keep cash flowing to reinvest. Safest end, government bonds, U.S. Treasuries, backed by the full faith and credit of the U.S. government. Munis, often tax-exempt interest. For high earners, tax-free yield can beat higher taxable yield. It's about what you keep. Investment-grade corporates offer higher yield than governments to compensate for slightly higher risk. High yield comes next. Higher default risk. Higher potential reward. Wealthy may allocate a small slice. International bonds diversify across economies and rate regimes, but add currency risk. Core principle: a diversified bond portfolio creates stable, predictable income and counterbalances volatile growth assets. We're talking about art and collectibles. For many it seems frivolous, a way to decorate mansions, but for the ultra-wealthy, it's a serious asset class. Tangible, scarce, beautiful, with potential for breathtaking appreciation. Scarcity drives value. There's only one Mona Lisa. Finite classic cars. They aren't making any more. Knowledge, authenticity, provenance, everything. It's opaque and risky. Experts matter. Social assets, access, status, connections, dividends beyond financial return. Gold, synonymous with wealth, power, permanence for millennia, but it's a shiny, inert rock. No yield, no dividends, no cash flow. It just sits there and costs you storage and insurance. So why own it? Insurance. Low negative correlation when financial assets plunge. A hedge against catastrophe. The wealthy allocate a small percentage, often around 5%, to precious metals to protect the downside. It's the fire extinguisher in the kitchen. You hope you never need it, but you're glad it's there. ETFs offer liquid, low-cost gold exposure without storage hassles. Mining stocks are a leveraged bet on gold with business risks, but can generate cash flow and dividends. Sophisticated investors blend physical bullion, ETFs, and miners for both bedrock safety and upside potential. Listen to me very carefully. Owning a business is the big one. You're not just a passenger. You are the captain, the admiral, and you decide how the spoils are divided. Control cash flow, reinvest, expand, hire, fire, pay yourself. It's the engine of wealth. Most fortunes start with boring, profitable enterprises that solve real problems consistently. Build systems and processes, replicate, scale, make money while you sleep, massive tax advantages. As an owner, you're taxed on what's left after necessary expenses to grow. Build a sellable asset and create a life-changing exit. That's how dynasties are made. Hedge funds are marketed as safe hedges, but beware the fees and risks. 2% of assets, yearly, plus 20% of profits. Brilliant for managers, punishing for investors. Yes, they access complex strategies not typical for retail, but complexity is a double-edged sword. After fees, many fail to beat simple index funds over time. It's a small, vetted diversification slice, not the core. Venture capital is the engine of innovation, and the riskiest asset class. Power law returns. A few outliers drive all the gains. Access is everything. Top-tier funds are hard to enter. They want strategic LPs with large checks. Money is locked up for years. Most startups fail. One rocket can change everything. Cryptocurrency. The new kid on the block. No intrinsic cash flow. Extreme volatility. Scams, hacks, and fraud exist, but capital has flowed in, retail and institutional. Ignoring it entirely would be foolish. The wealthy treat it as venture speculation. A tiny slice, with asymmetric upside. Many also prefer revenue-generating ecosystem plays over the coins themselves. So there you have it. We've pulled back the curtain. 10 primary asset classes. This isn't about magic. It's a disciplined, diversified strategy. No single silver bullet. Build a fortress. You may not buy a Picasso tomorrow, but you can start today. A share of a REIT, a low-cost index plan, a cash-flowing side business, diversification, long-term thinking. Focus on cash-producing assets. Think about your situation, your goals, and your risk tolerance. Which one can you take the first step toward today? Don't just watch. Start building your financial fortress, one brick at a time. The path is clear. Now, you have to walk it. If this helped, subscribe for the full series on each asset, drop a comment with your first step, and share this with a future millionaire in your life. Disclaimer: we are not financial advisors. This content is for educational purposes only. Do your own research and consult a qualified professional if you're not comfortable making financial decisions on your own. See you in the next masterclass.